The shortest month of the year is over, and it didn't pass without incident. We've seen new record highs in equity markets, data surprising, and markets reassessing about what's coming next. I'm joined today by Fund Manager Dean, who's going to help us make sense of what's been driving markets in February. Dean, if you had to sum it up into three themes, what would they be?
Thanks, Sean. I think the themes for this month were inflation surprises, artificial intelligence earnings results, and technical recessions.
So let's start with the first theme. So at the end of last year, markets were getting quite excited about the prospect of interest rate cuts. However, this year, those expectations have been reined in. What's been driving that?
So at the end of last year, markets were expecting between 6 and 7 interest rate cuts in the US in 2024. A significant resetting of expectations means now only 3 are priced. The reason? Inflation. January's CPI was 3.1%, which was above consensus expectations and some way from that 2% target. Alongside strong jobs numbers earlier in the month, markets interpreted these data as insufficient progress on bringing inflation down to that 2% target. So that questions the narrative around when the Fed might be able to begin its rate cutting cycle, pushing out that first cut from March to sometime in Q2.
Okay, so less cuts than markets were expecting. So let's move on to your second theme. When I think about artificial intelligence, I think about Nvidia. They immediately come to mind. They're the third largest company in the world. They released their results last week. How did markets receive those? And we've even got some people talking about an AI bubble because of how big they've become so recently. Are they a victim of their own success?
Yeah, good question. So the Nvidia results were indeed reasonably significant for markets because of all the optimism surrounding technology and AI. They beat the market's already high expectations with revenues up an astonishing 265% from a year ago. The stock trades at a bit of a premium to the technology-heavy Nasdaq, but it's delivering so much earnings growth that the valuation hasn't gone stratospheric. The AI theme extends to a whole host of other companies and has driven large gains in the S&P 500. The S&P 500 itself posted an all-time high in February with gains in 15 out of 17 weeks. The last time it did that was 1989. The rally isn't just concentrated in AI stocks, which gives you hopefully a bit of confidence in its persistence. So the average S&P 500 stock is up about 2.8% this year compared to 6.5% for the market cap weighted index. So that tells you that the bigger stocks are still outperforming the smaller stocks, but by much less of a margin than they did last year.
Okay, so buoyant equity markets and AI seems to have been delivering so far. So on to the final theme, which is technical recession. We saw the UK fall into a technical recession, which is technically 2 consecutive negative quarters of growth. Is this something we should be concerned about? And are we seeing any other economies in a similar position?
Yeah, so the UK shrank by 0.3% in the final 3 months of 2023, following a 0.1% contraction in the prior quarter. This grabbed headlines, as you might expect, given how close we are to a general election at some stage. We've seen a persistent pattern of low or no growth in the UK for some time and expect more of the same looking ahead. However, it's not all bad news. The jobs market remains resilient, and one bright spot is investment, especially non-residential, which is growing between sort of 4 to 6% in most categories. Inflation has been moving in the right direction for the Bank of England, but interest rate cut expectations have similarly been pushed out to later in the year. The other interesting case is Japan. That also technically entered a recession, but the reason for this was largely seasonal factors and it should rebound. We've seen the Japanese equity market perform strongly and the Nikkei index reached an all-time high in February, similarly its first since 1989.
Thanks, Dean. So my main takeaways are: 1, markets now expecting 3 rate cuts in the US this year. 2, AI earnings are now backing up those higher valuations for now. And 3, technical recessions may not be as bad in the UK and Japan as they might sound on the face of it. So as you know, we like to round up these with a monthly stat that's caught our eye. So this month, Nvidia broke the record for the biggest increase made in value in a single day. They added 277 billion to their market capitalization after announcing their results. That's equivalent, to put this into context, to the entire value of Coca-Cola. Thanks, Dean, for your insights, as always, on markets. And we'll be back next week with another interesting topic that's caught our eyes from markets. And thank you for watching and see you soon.